And we're live. We're rolling. We're not live, but we're rolling. We'll edit it and put it all together, so we won't really be live. But anyway, it's Monday, April 21st, 2025, and this is another installment of Momentum Mondays.
Yes, it is.
We're going to
It's
dive into it. Very interesting weekend last week. Lots of fun stuff. So anyway, go ahead and do the disclosure stuff, and then we'll jump into the return data.
As always, nothing in this podcast should be considered investment advice. Investing does involve risk, including the risk of loss. Consult an advisor you trust or visit us at momentumwealth.us to get advice about your specific situation. Be more than happy to talk to you.
Excellent. All right, so we had a little bit of a short week last week. Good Friday, the markets were closed, but so we had a 4-day week last week. S&P down 1.41%, the Nasdaq down 2.27%, Dow Jones down 2.5%. Russell 2000 actually up 1.15%. I do want to mention this a little bit later, but this is a very interesting metric where you have the index is by and large down, and then you have your Russell 2000, which has sort of been an anomaly for like a year and a half now, and that was up last week, which is very strange. We'll talk about why that might have occurred in a few minutes. But we got gold up 2.75, silver up 1.23, 10-year bond up 1.25. Again, this is the price that's up, meaning yield down last week. Bitcoin down 1.41% on the week. And this is, again, Monday through Thursday. Bitcoin did trade on Friday, but I'm not including this in these return values. Another one that I wanted to kind of touch on, because it's kind of interesting. We've been getting questions about it, and we have actually pivoted into it. But the international stuff, if you look at international last week, it was up also, maybe a point or so. So there's been this rotation, that's been happening in certainly out of tech and into a lot of other areas, but are small companies and the Russell 2000, which is made up of small companies, is that something that's going to benefit from this rotation? And why would that benefit? Why would that be the case that small caps have a divergence last week when everything else is down and people are piling money into the small caps?
Yeah, I listened to Austin. I think it's Austin, the Fed chair out of Chicago. Forgive me for not knowing his last name. I won't be invited to his dinner party as a result.
That's an
But
unforgivable. We won't forgive you for that.
listening to his commentary this morning, and it really gels with kind of the opinion that I've had this entire time since the start of the tariff tantrum, is what I've called it. Trademark, hashtag trademark tariff tantrum.
Goolsby.
Austin Goolsby. Well, I thought it was Goolsby, but then I was like, is that the name of an actor? And I didn't want to say it. So anyway, listen to his commentary this morning, and it's really the business leaders' long run inflation expectations are trending down. Expect, he didn't outright say this, but reading between the lines, expect CPI to surprise to the downside. We have oil, we have gas, we have a lot of input costs that are not, I mean, oil's down 30% year over year. That's going to have a major impact. We have housing,
is CPI
inventory
going to the downside? Is that something that would be surprising though? Why would
I think
I don't know why he would frame it like that.
It would be surprising. He did not specifically say that, but the implication of what he is saying is that you would think that is a giant bug. The implication that you would think is that the data is diverging from the sentiment. Now, sentiment can alter that, if sentiment is bad enough. So, or well, depending on what part of the business cycle you're in, but yes, sentiment can alter that. But it's very interesting, talking about some of the hardware manufacturers that are in the Midwest, specifically around tools and tooling. They're already actively shaking up their supply chain to be able to control cost. And whether that be onshore or whether that be work with some different trading partners other than China. And it's basically at the end of his 18-minute conversation, you really get the look that, imports, are 11% of GDP. The vast majority of our GDP is domestic. Now that's going to be services, not the production of raw materials and goods, but only 11% of the GDP is imports. So it's really looking like, as more trade deals are announced as we walk through this 90-day period, we're really building a strong base here with sentiment kind of getting as low as it's going to get. CPI trending down, expectation for Federal Reserve rate cuts going up. We're entering that phase to where um, there's the potential for a pretty strong recovery as we go into the latter half of the year. And so to answer, that's a very long way to answer your question about why would we be seeing the divergence between small cap and some of the, and it's really because um, the market's really beginning to understand that it's not that bad, and these companies are able, we call them small cap, but that can carry all the way up to a $10 billion company. So these companies are well-oiled machines that adapt. They're very nimble relative to some of the other players in the market. They adapt. They are adapting, and I think once once the reality of the situation can be compared to the sentiment, you know, we're gonna have an upshoot in some of these sectors that have been really overhit, and small cap is one of them. Small cap has been a favorite of ours to watch, going back to last year in the early summer, and so really would love to see that outperform. And we're also seeing some divergence with Bitcoin. Now, you mentioned in the opening monologue, Bitcoin being down last week. We've already recaptured all of that and up some today, it looks like. So we're seeing a divergence in your safe haven assets, Bitcoin and gold, and beginning to
Yep, gold especially.
disconnect from the NASDAQ. Um,
Well,
and that's
specifically
interesting and well.
Bitcoin, not really gold.
Yes,
Gold,
Bitcoin, correct. Yeah.
yeah, Bitcoin and the Nasdaq have trended closely together, and people have wondered when that was going to be a thing that changed. At some point, it has to diverge, and so we're seeing that happen now. But the other thing with small caps specifically is that typically small caps tend to lead when people are looking for a recovery. We're looking for an early sign of economic stabilization. So that would be something else interesting to watch. The other thing, I guess, is that small caps and Russell 2000 specifically have been beaten down so much over the past 18 months that, I mean, are they already there? I mean, is the
Yeah.
capitulation already in the Russell 2000? How much more can it be beaten down, and for what reason? And so, that maybe it's just what it is and where it is. Maybe that's why it's receiving a lot of inflow, or
Yeah,
or
it's very
popping up.
possible. And for those that are new to investing, new to looking at the markets are forward indicators, forward looking. So you're going to have, when there's uncertainty or there's a step change in policy, you're going to have pricing in very, very quickly as people try to get ahead of what news may come, to get ahead of what events may come, to get ahead of an upswing in the economy or a downturn in the economy. And I think you're right. A lot of the pricing in of the uncertainty has happened. It seems to probably be bottoming, especially with the Russell 2000. I think tech's a whole nother animal. There's a whole lot more going into that than just simple tariff policy and tax policy. But you got to think about the Russell 2000 and what it did during the last tax cut. And depending what comes out of the Congress and the Senate with the new tax policies, you could see a rip roar and rally potential. It's theirs. The potential is there, and I think if you're sleeping on tax policy and trying to understand what type of market movements are going to come once that's passed, you got to wake up, because the Russell 2000, out of all of the indices, in my opinion, stands to benefit the most from deregulation and low taxes.
Yeah, I mean, that's a good point. I would say that, whenever a downturn happens, whenever a pullback happens in the market, people are always waiting for the recovery on the other side of that. I mean, I think that's a constant. I'm not sure how close it is to us. I don't know that I would, I don't know. It's as soon as I say something about it, or give a time frame, I'm going to look like an idiot. But I would be shocked if it comes sooner rather than later. In sort of a, not even, we're not even talking about a longer term, multi months type situation. I would just say maybe weeks. But we have to get some things happening in the market. We have to get breadth, BREADTH. We talk about that a lot. We got to get that back up. We've got to get the number of stocks advancing versus declining. We've got to get that turned around. There's a lot of technical things that have to be repaired in the market for us to feel comfortable that this is something that is going to be a bottoming sign as well as something that we can get a lot of forward motion in. And so
And
last week, again, you also had the S&P 500 and the NASDAQ 100 triggering what's known as a death cross, which is a technical signal that occurs when
ooh,
your
that sounds
50-day.
terrible. That sounds
Yeah,
terrible.
it sounds terrible. It's a technical signal. It occurs when your 50-day moving average crosses below the 200-day moving average, and it's generally potentially seen as a warning sign, but it doesn't always immediately mean that there's going to be a huge decline. It's a lot of times once that happens, we're already in the throes of something, kind of like we are now. So it's just one of those things we have to constantly watch for. But we do like to see decreasing, volatility. Of course, the VIX, we need to get that down. We need to get the breadth up. We need to get higher highs and more stocks participating in that. We need to get good upside days where we don't have a lot of downside. And so, that is something that we're going to look for when we're looking at the technicals of the market. And it's still kind of hairy. And we just week after week of us just saying that the signals are mixed, and they are. And it's frustrating for everyone involved in the
Yeah,
whole
and
thing.
and it can be,
But it
and
just is that
in
way.
our the tactical portion of our portfolios, we did raise cash weeks ago. And like you alluded to at the opening, our international's doing great. We've even had some, I wouldn't call it divergence yet, but we've had some pretty good, strong days with real estate um, compared to the market indices. And so, yeah, it is a fragile, we're in a, technically speaking, a fragile zone where you really have to be disciplined, tighten your focus. And that's what we're doing here with our clients' portfolios. And I am kind of liking what I'm seeing as we walk through this period of weakness. And which is just going to be very interesting. I think, I'm thinking 6 to 8 weeks from the beginning of what, again, I now have officially trademarked, and we'll have to get t-shirts made of the tariff tantrum, which goes back to the taper tantrum back in I think it was 2013. But yeah, I mean, one thing that, you know, I think I said about 2 weeks ago, is looking at crypto and looking at Bitcoin, and what the data that we're looking at was basically calling that divergence, that we're going to see the decoupling um, of crypto, and specifically the Nasdaq, and that the greatest likelihood was an upward trajectory for Bitcoin. So, our we were, even though we reduced exposure to some equity positions, we did not decrease exposure in the crypto sleeve of the portfolios. And that seems to be working out very well. Crypto is a whole nother animal. It really, as you look back in time, you do have these periods where it'll move in lockstep with the NASDAQ, but you also have periods where it itself is a leading indicator of what's to be expected with the money supply, and the growth of the money supply, which is kind of giving you a nod and a wink that we are getting ever so closer to uh, lower interest rates and the complete stoppage of quantitative tightening. Now, the last Fed meeting we talked about that I would suspect they would begin to reduce quantitative tightening. They did. The next time we hear from the Fed, I predict they will stop it completely. Um, so that's probably upcoming. And in Bitcoin, again, is kind of giving you that wink and the nod. It's picking up on, we're about to enter a new liquidity season, with rates trending lower. And that's another thing that Austin Goolsbee said this morning, is that, really they're just looking at this 90-day period, and trying to get a handle on how they continue their dovish policies going forward. But he has full confidence, 12 to 18 months, that we're looking at much lower interest rates. And I think it's going to be much quicker than that, but we'll have to see. But we got to remember CPI coming in at 2.6, and I've done several calculations factoring in the reduction in the price of oil, how that affects bulk goods being shipped, taking the baseline tariff, applying it, and we're really only looking at between a 6 to 8% cost increase just on the baseline tariff, because of how much oil has come down, and it could even be at a break even on the cost, the cost of goods landed. So even if that is wrong, and off a little bit, and CPI is printing 2.6 by September, maybe it prints 2.9, the Fed is still over 4. So we're still in significantly restrictive monetary policy. And what's happening in the bond market is flashing all kind of signals at the Fed, that rates on the short end have to get lower. So it's going to be very interesting, full of excitement as we enter into springtime. And it's listening to our podcast every week. A lot of it, because of we're in this unknown kind of environment. A lot of it may seem repetitive, but it's really good to stay very focused on the data, very focused on what's happening, and being able to make sure to provide that we're there to provide clarity and confidence to clients or people on the sidelines that are looking to become clients. And so, um, you know, if you're tired of us saying we have to wait and see, I'm sorry, but it still looks like we're going to have to wait and see before we can put our stamp of approval on the bull market continuing in the short term.
Yeah, I mean,
I
I
think we're
think
still in
that's
the bull
right.
cycle long term. Um, I think again,
Well, that's
I
one
have
of the
pretty high
things that
degree of
we
confidence.
haven't. That's one of the things we can't really. I don't think there's enough info to make a determination on that as of yet, but it's
I don't
possibly
have any wood to knock on,
certainly
so
possible. I do.
it's
I'm
metal.
recovering.
It's metal.
It's certainly possible, but it's something that we are going to keep our eye on for sure. I haven't seen anything new today come out about the tariffs or about any negotiations or anything like that. So I think that, um, I mean, it's just a whole lot of it's one thing, one indicator would say this and the other indicator would say something else. So it's a lot of just take a pause, take a step back and watch kind of what's happening. And we are doing that actively in the portfolios that we're managing, certainly trying to keep abreast of everything that's happening underlying under the markets, the technical aspect of it, but also in the news, the popular news that tends to move it a lot too. You see a lot of stocks really kind of whipsaw back and forth based on a lot of different things. Certainly, tariffs are one of them, and really, uh, a lot of it's happening in Nasdaq specific sectors that were already really high valuations. So, is that the other part of this to where maybe this is just something that's going to come back and make those companies more attractive from an investment standpoint, whereas they were before this parabolic rise. Companies like Nvidia, the Mag 7
Well,
stocks essentially.
we've seen this happen. Over the last 3 decades, we've seen where there's a lot of hopium that gets built into tech. And then for whatever reason, maybe it's a change in the business cycle, or maybe people realize that, pets.com is not actually worth $1 billion or whatever the ridiculous valuation was back in 1999, 1998. And then things correct. I will say, I think this time is different because we're not the bull run and the Mag 7 melt up, I guess you could call it, is not built on hopium. We're actually seeing real world um, changes that people can see, can touch. It's tangible. It's getting into the zeitgeist of the culture. All things artificial intelligence, and if anything, kind of to just lean on what you said a little bit. I think it's creating an exciting entry opportunity for people that have been wanting to get exposure to kind of the Mag 7, to some of the big tech, to some of the AI plays. But it's also going to give an opportunity for people to look at the sector as a whole and say, hey, there's a lot of innovative companies that may not be in the Mag 7. Maybe they deserve to be in the Mag 7, and it could give a reset for people to start looking at the next Nvidia, or looking at how is Tesla going to be adapting in this space with automation, and not just with FSD but also with the Optimus robot. Let's look at how is Apple, are they going to be innovating, or are they going to be struggling? All of these things is very interesting, but these are real world. It's not the hope of artificial intelligence. In fact, I went to Louisiana this weekend, was there very briefly on some family stuff, and just on the drive back. If you're not aware, it's a long drive. But hey, the
This is
car
a
did it
long
for
drive.
me. I hate to beat a dead horse, but the technology is here and it is happening and it is changing things. And it's remarkable to take a 7-hour drive and barely touch the steering wheel, or the pedals or the blinkers or anything. Just let it scoot you on there. But as we were driving or riding, depending how you look at it, my son, my 13-year-old, was talking about, he's been using Chat GPT a lot, and he was looking at he loves the games, the gaming and the online gaming stuff, and so he was looking at getting essentially the coding aspect of getting artificial intelligence to receive instructions vis-a-vis a video, say a YouTube, say a gamer, and then take the instructions verbally and then code a mod, or code a new game. And it's just remarkable, the technology that's out there. And what we're on the precipice of some pretty big changes. And so that's why I do think that this time is different as it pertains to tech. I think people are still gun shy, some PTSD going back to what happened to tech in the late 90s, early 2000s. But I do think this time is different. It doesn't mean just go dump all your money in tech and 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 hope for the best. You have to be intelligent, you have to be diversified, but you have to pay attention. And just because people are really throwing a lot of mud at the Mag 7, that doesn't mean that you should shy away from tech. It should definitely be either part of a portfolio or always in consideration based on the technicals.
Well, I think that's the diversification really is the key for that. And we're seeing that in the rotation from domestic equities, which has been in leadership over the past decade, to now we're starting to see international and ex-US investments sort of take off and be a good place that investors are going to get, better return, at least in the interim, while the US markets are experiencing this sort of flipping and flopping. And it's just speaks to the value of having a lot of different ideas in a portfolio. Now, sometimes you don't want to have them all the time. There are certain periods of time where you want to diversify, globally, and there are other times where you may want to be overweight domestic or overweight international, just in the event. And we use various indicators to help us do that. But
Yeah, and, you,
certainly it's an
and the
interesting conversation to
importance,
have.
and just to stop you there for a second, because the important part of what you said is using the indicators. So what that means to somebody that may just be listening to us for the first time is that you don't bring your opinions and your biases to portfolio construction and executing rebalances and sector rotation. You have to look at the data more times than not, and I would probably say almost 90% of the time. A lot of times what you may think or what your bias may be leaning towards is not necessarily the sector that's going to outperform. And emerging is definitely, like you said, over the last decade, it's international, even longer than a decade, international and emerging has been dead money. And so when you
Yep.
see the data pointing to that it's time to begin some allocation towards those sectors. If you've lived through that, and you would have a natural bias say, no, that's just dead money, but you got to pay attention to the data. And we are really seeing an outperformance to the major indices, which we haven't seen in quite a while. So you have to be open-minded. You have to talk with a professional. You have to get with somebody you trust that understands these things, and doesn't just put you in a cookie cutter portfolio that's not paying attention to all the data. Same thing we told our clients when we introduced crypto years ago. So listen, we're paying attention to the data on this, and this is an asset class that we have to have. In a risk managed way, we have to have allocation and access to this asset class while everybody else had their head in the sand. And as such, it's done very, very well for us.
Yeah, we never can turn our noses up at something or pretend it doesn't exist. That's a lot of times what you get in the advisory space with financial advisors that are maybe working with a larger corporation, or they have certain products or things that they can sell or have access to. That is a strategy that, in my opinion, that doesn't work very well. You always have to be open to anything. Maybe there are really stupid ideas, maybe they're really good ideas. You always have to vet those ideas for what they are and figure out what benefit, pros and cons that those might have to a portfolio. And we don't take lightly when that kind of thing happens, when we're looking at maybe new asset classes to introduce to the portfolios. But it's one of the fun parts about this job, to kind of look and see, try to skate to where the puck is, in the words of Steve Jobs.
Yeah, good old Steve Jobs. And we can look at this with gold. Crypto. You know, um, Crypto is an easy one because for us, because of the amount of research and data that we did. We did the hard work in understanding that asset class. Um, and I would venture to say it was probably about, it was hundreds of hours, over a period of time. And if not over 1,000 hours, I would say dedicated purely to that asset class and building out how we allocate, how we increase or decrease allocation. A lot of hard work went into that. So that's kind of an easy was because and it's recent too. It's kind of an easy one for us to look back and say, look, here's a winner, and here's how you benefit from being open-minded and paying attention to the data. But let's look at gold. You know,
Yeah.
if we look at where we were 2 years ago, when when we I'd have to look back and know exactly when we turned on our, I think our gold indicator uh, flipped very strongly in 2022. Um, you'll have people out there that'll get on the radio, get on the news, and they'll uh, you know talk about it. Well, over a period of time, the S&P outperforms gold. Well, that's true, but when you're being very tactical and you're
Not
looking at the
anymore. Not
data,
currently.
yeah, not currently. Over the last 24 months, we're up over 70% on on our gold allocation, and we're not always going to be in gold because over time the market is going to outperform gold. But if we have a period of time to where we can, using the data, allocate a small percentage of portfolios to an asset class that has the potential to go up 70-80%, it's we're going to pay attention to the data. We're not going to listen to talking heads or to um, other people's opinion, because the data's pointing us in this direction. Same thing can be said for um, real estate. Same thing can be said for oil and gas. You're going to have periods of outperformance, and you want access to that because that provides so much more. What we call in the advisory and the money management space, we call alpha, and that's just excess return. And that's what you want. That's what you want your advisor to be doing, is searching under every rock, for the ability to give you good risk-adjusted returns that you otherwise would not get. And
Or
gold
by
has
the same
just been.
token, when to be defensive with portfolios. By the same token, there's a lot to be
That's
said
correct.
for an advisor really making the case for their work in difficult markets. Our gold indicator flipped in November of 2023, so we went back in at that point.
Let's see then, so I can correct for the record.
Let the record show.
Let the record show. Let me do my little calculations here.
Yeah, I mean
And
the end result here, the over the
it's, I'm
30,000 foot
sorry,
view
it is 68.4%, not 71. For all the YouTube
the over,
commenters, I apologize.
yeah, the overall like 30,000 foot view is obviously diversification, but also rules based methodology, so that it's not being done by emotion. Emotion is the number one. I don't know if it's number one or not, but I would say it's the number one
Yeah, I would
destroyer of
agree.
wealth, because when you make impulsive emotional decisions backed by nothing, it's a very difficult thing to recover from if you're doing that in the midst of market chaos.
And I
It's
and I will
never a good idea.
I will say this, and let's see if you agree. And I know we're running up on our time here, but let's just see if you agree with this. I would say for accounts under $1 million, the most money your advisor is going to make you, you're not going to see reflected in your account. It's going to be the bad decisions they help you not make and the mistakes they help you avoid are going to create a million may be high, it may be less than that, but I would say that sub $1 million accounts, any advisor that you're working with, if they're working with you correctly, the most amount of dollar value as you get to that $1 million mark is going to be mistakes they helped you avoid, and keeping you on the straight and narrow from a financial perspective and from a financial planning perspective. And that can come in the way of, doing some education on, maybe you shouldn't be overweight so much to your company stock, and being able to reallocate that in that 401k instead of having 100% in your company stock. Let's get a proper allocation. And then 2 years later, the company stock goes down by 80%. We've seen that happen. That advisor saving you that type of decline in concentration. And some people's risk tolerance are perfectly acceptable to that. It really comes down to a personal situation. But for the broad spectrum of people out there, um, having those conversations and being able to help you avoid these very, very costly, emotionally driven mistakes is probably going to be the most money as you walk up to that $1 million that your advisor is going to make you.
Yeah, I don't know that that really is. It's an interesting thought. I don't know if it really has to do with dollar amounts, because I think there are across the board investors with all kinds of net worths are capable of making decisions that we would maybe not say are smart
That's
decisions.
fair. Yeah, that's a fair point. Yeah.
And so I think that a lot of times, definitely part of our job is behavioral, talking people through decisions, walking them through, why maybe it's not a good idea. I'll pick on the low hanging fruit, which is Social Security at age 62. That's a low hanging, that's what everybody comes to us about. Why can't I take Social Security at 62? When should I take Social Security? And why a lot of times we don't recommend taking Social Security at 62. There are very specific situations where we think that that's probably okay, but things like this is just it warrants and it merits looking at a bit deeper. And so that's a large part of our job, but the other part is diversification and making sure the portfolios are taking advantage of the upside when they need to be, but also defensive when they need to be. We're not opposed to doing that. We're not opposed to holding cash in the portfolios if we think it's a good time to hold cash. And that's not always apparent either. I'll tell you, that's not always apparent in the short term. It takes sometimes a little while for that to become apparent, if it was a good idea or not. Now, we can look at indicators and we can look at data and we can make our decisions. And it's going to be frustrating sometimes when, um, you know, uh, the market, you have an update, like a big update one day when you're in the middle of a larger sort of downtrend. It's just, um, that's sort of the idea that we have, is looking at everything, taking into account and making those decisions when necessary. And over the long haul, over the long run, in the long term, those will pay off, and they have historically. But a lot of times it's hard in the short term to sort of understand what's going on. There's my
Yep,
rant. I'll end the rant.
that's it. You've got it. Well, I think we need to take a wrap here as the day warms up. This is not a green screen. I'm actually outside. Beautiful morning today, but there's a lot of flying insects that are appearing. So I
Yeah,
think
the
that's my
cicadas are supposed to
sign.
be coming soon.
Really? Is it like a cycle of them or something?
Yep. I think it's
Yeah.
going to be a problem again this year. Cicadas.
Those things are
But
so
yeah,
loud. It's like a jet engine.
but yeah, that's a good place to wrap it up. Anyway, moral of the story: still a lot of muddy data that we are parsing through. We'd like to see some more upward trend in the market. Today certainly is a down day. We would like to see some repairing before we get really optimistic about things. But we'll keep our eye on things. We've got some things coming up this week as far as durable goods orders, consumer sentiment stuff, new home sales. So we'll keep an eye on all of that. And if you like this video, please feel free to share it,
Yeah.
follow it, go to social media pages. We're all out there, always doing videos.
YouTube,
If you,
Instagram, TikTok.
yep,
We also have some media appearances that we've taped that'll be airing soon that we'll be putting on there as well.
yeah. So if you're looking for somebody that is able to have the conversation, able and willing to have the conversation about decisions, why they're made, what decisions affect what parts of your life, definitely reach out, momentumwealth.us, and we will look forward to seeing you guys next week.
Everybody take care. Have a safe week.
Bye-bye.